You know, if you've been watching the financial news lately, you might be getting this weird sense of déjà vu. All these headlines are screaming uncertainty, and it's kind of hard not to let your mind drift back to one specific year, 2008. But here's the real question we're tackling today. Could it actually happen all over again?
It is a scary thought, right? Another massive global financial meltdown. But to really answer that, we can't just look at what's similar. We have to dig into what's different. Because, yeah, the fear might feel the same, but the actual mechanics of our economy, they've changed in a really fundamental way. And that one change could make the next crisis, well, unbailable.
Think back to the solution last time. It was that huge government bailout. I mean, it was controversial for sure, but that was the playbook, right? You inject a ton of money, you stabilize the big banks, and you just cross your fingers and hope for a recovery. So if we stare down the barrel of another crisis, can we just run that same play again? Well, the analysis we're looking at here suggests a pretty clear answer. No way. Okay, so let's start with the first huge problem. The rescuer from 2008, the US government, just isn't in the same shape it was back then. Its ability to just swoop in and save the day is seriously in question. And this quote, man, it just cuts right to the chase. This isn't some political opinion either, it's just a hard financial reality. The government's sheer capacity to launch another massive rescue mission like that is nowhere near what it was 15 years ago. And this chart just paints the picture perfectly, doesn't it? I mean, just look at the difference here. Our national debt has absolutely skyrocketed since 2008. Back then, the government had more wiggle room, a lot more capacity to borrow and spend its way out of trouble. Today, that room has shrunk a lot. So here's the bottom line. The government's hands are tied by two huge constraints. First, that mountain of debt we just saw, and second, we've already got an inflation problem. The 2008 solution was basically to print trillions of new dollars. Trying to do that today would be like throwing gasoline on an already raging fire. The old tools are just way too dangerous to use this time around. But look, the government's weaker position is really only half the story. And honestly, it might not even be the most important half. The real danger, the biggest difference between then and now, is all about the kind of debt that's fueling our economy. Okay, now this slide is where it gets really, really interesting. This is the core distinction. See, in 2008, the crisis was mostly about debt that financed lifestyles. Subprime mortgages for houses people couldn't really afford, crazy credit card spending. But today's debt, it's completely different. It's financing productivity itself. This quote just nails the whole vibe of 2008, doesn't it? It was all about consumer debt. And when that system collapsed, it was absolutely devastating. But it hit households first. The impact on businesses and jobs was like a powerful aftershock, for sure, but it wasn't the initial explosion. Now contrast that with today. Just look at this breakdown. This kind of private debt is literally the lifeblood of business. Companies aren't just using debt to build a new factory. They're using it to function, day in and day out. They are borrowing money just to make payroll, to buy the inventory they need to have something to sell, to fund the very services they provide. This debt is woven into the very fabric of how things get made and done. And that huge shift, well, it leads us straight into something called the productivity trap. This is where we start to see why a modern debt crisis would unfold so much faster and probably so much more brutally than what we saw back in 2008. So let's be super clear on this term, productivity debt. This isn't about borrowing money for some speculative venture. This is the debt that lets a company open its doors on a Monday morning and actually pay its employees on Friday afternoon. It is directly and completely tied to a company's output and its jobs. So what happens when this kind of debt goes bad? Well, check out this chain reaction. It's not a slow burn. It is a series of dominoes falling one after another super fast. A business can't pay its debt, so it can't make payroll. Services stop. The next day, people are literally out of a job. The entire productive engine of the economy takes an immediate, direct hit. And that right there is the absolute key. In 2008, a bank failed, and then that shockwave eventually, over time, led to layoffs. Today, a company's line of credit freezes up, and the layoffs could happen almost instantly. There's no buffer. A financial crisis and a jobs crisis are basically the same event. So when you combine a government that can't really act with a crisis that's hardwired to hit the economy directly, you get to this really unsettling conclusion. We might actually be facing a truly unbailable crisis. And look, this isn't just some abstract theory.
These are the kinds of concerns being whispered around in financial circles right now. There's this real anxiety that the Fed might get forced to rescue an entire industry that has, almost without anyone even noticing, become critical to the entire system.
This quote is so chilling because it perfectly captures how hidden this risk is. I mean, in 2008, everyone knew the big banks were the problem. Today, the risk isn't all concentrated in a few towers on Wall Street. It's spread out across thousands and thousands of businesses, all depending on this productivity debt just to function.
So let's just recap why this might be unbailable. 1, the government's hands are tied financially. 2, the problem isn't in a few big, obvious places. It's everywhere. And that leads to the real head-scratcher. What would you even bail out? You can't just give a lump sum to a bank. How do you bail out the ability for thousands of different companies to make payroll on Friday? It's a logistical nightmare.
And that brings us right back to where we started, but with a much, much sharper question. We pretty much established that the whole nature of economic risk has changed. The old playbook from 2008 is obsolete. And that leaves us with the most important, and for now, completely unanswered question of all. What's Plan B?